Hello, this podcast will start in about 10 seconds. Here is a quick disclaimer. This podcast is not investment advice. Information is for education purposes only. Everyone should do their own research and consult with a CPA before making investment decisions. Investing in the stock market may result in the possible loss of money.
You know that feeling. It's almost biological, right?
Oh, absolutely. It's a gut punch.
Yeah, exactly. You're sitting in your couch or maybe at your desk, and your phone just lights up with a breaking news alert.
And it's never good news.
Never. It's a major global crisis. A border has been crossed, missiles are in the air. You turn on the television, and you see the chaotic footage of troops moving, the emergency press conferences from world leaders looking super grim at podiums.
Right, the whole geopolitical panic cycle.
And if you have a 401k, or if you have like a college fund for your kids, or if you just generally care about your financial survival, your immediate gut-level reaction is visceral panic.
Yeah, of course it is.
The internal monologue is always the same. It's always, the stock market's going to completely crash. I need to log into my brokerage account, sell every stock I own, buy gold, and maybe start hoarding canned goods.
I mean, it is a completely natural assumption. We are so culturally conditioned to link geopolitical tragedy directly to financial collapse.
Which makes sense, logically.
It does. We assume that because a human event is devastating, because it involves kinetic warfare and, destruction, the economic machinery of the world must break in equal measure.
Right.
But the reality is that the stock market is not a human being. It doesn't have a conscience. It is an incredibly cold, rational, and frankly, indifferent calculating machine.
Which, it feels kind of wrong to say out loud.
It sounds callous, yeah.
It does, but that is exactly what we are going to prove today. For this deep dive, we are essentially acting as your personal research analysts.
We've brought the receipts.
We really have. We've pulled a massive stack of historical data from the past 100 years, tracking how the U.S. stock market, specifically the S&P 500 and its predecessors, have actually performed before, during, and after major military conflict.
Because you need the hard numbers to see the truth.
Exactly. We are going to look at those hard numbers to find the common threads. And then we're going to take that century-old historical playbook and apply it to a very real, very pressing hypothetical that is keeping geopolitical analysts awake at night right now.
A potential large-scale conflict with Iran in 2026.
Right. So to frame this entire conversation, where exactly are we getting our data?
So we are drawing heavily on some highly rigorous institutional research. Specifically, we're looking at historical market reviews from the CFA Institute and a massive post-World War II event study conducted by RBC Wealth Management.
Okay, heavy hitters.
Very. And when you synthesize decades of their findings, a very clear, defining thesis emerges. The market's response does not depend on the mere existence of a war.
Wait, really? The war itself isn't the trigger?
Not at all. The market response depends entirely on whether that specific conflict inflicts damage on three structural pillars.
Okay, what are the pillars?
Global energy supply, North American corporate earnings, and the broader U.S. business cycle. If those three pillars stand, the market stands.
Yeah, if they break.
If they break, the market breaks.
So it's not the war itself. It's the collateral damage to the economic machinery.
Exactly.
I want to jump right into the intuition versus the reality here, because the intuition is that war equals a devastating bear market.
Everybody assumes that.
But when you look at the broad findings from the CFA Institute covering World War II, the Korean War, the Vietnam War, and the Gulf War, the data is almost offensively counterintuitive.
It really shocks people.
Large-cap U.S. stocks generally outperformed their long-run historical averages during wartime.
Which just sounds wrong, right?
It sounds completely wrong. Now, Vietnam was a slight exception in relative terms, but even then, the returns over the course of that era were positive.
They were.
So the baseline fact we have to accept, as crazy as it sounds to you listening right now, is that wars do not reliably produce prolonged bear markets.
Let's actually look at the RBC Wealth Management data because they quantified this in a way that really strips the emotion out of it.
Yeah, break down that study for us.
So they conducted an event study analyzing 20 major military interventions and periods of hostility post-World War II.
20 events.
Okay. 20 separate instances where the headlines were screaming that the world was falling apart. 20 moments where retail investors were absolutely terrified.
And selling everything.
Exactly. And yes, there is always an initial shock. The market is not blind. But across those 20 events, the S&P 500 fell, on average, by only 6.0% from the start of the event to its lowest point.
Wait, 6%.
Just 6%.
Put that in context for me, because when I hear war, I'm thinking of a 30, 40, or 50% haircut on my retirement.
Right, you're picturing the Great Depression or the 2008 financial crisis.
Yeah, 6% is what a major tech stock loses on a Tuesday afternoon because, like, the CEO gave a weird interview.
It's nothing.
That is a routine, almost boring market correction.
It is a mere stumble. In the context of global warfare, a 6% drawdown is essentially a rounding error.
That is wild.
But the truly remarkable part isn't just how shallow the drop is, it's the speed of the recovery.
How fast are we talking?
In 19 out of those 20 cases, the market returned to its pre-event level in an average of just 28 trading days.
Let's pause on that because I want you, the listener, to really map this out on a calendar. 28 trading days is roughly 5 to 6 weeks.
Barely a month and a half.
You have a major geopolitical crisis. Aircraft carriers are deploying. The UN Security Council is in emergency session. The world is holding its breath.
And the stock market just completely erases the loss.
Right. It gets back to business as usual in a month and a half. Who is buying when everyone else is panicking?
Institutional capital.
Wow.
The massive pension funds, the algorithmic traders, the hedge funds, retail investors, everyday people, they tend to sell on the headline out of fear.
Because they're watching the news.
Exactly. But institutional capital looks at the underlying data. They realize the fundamentals hasn't shifted, so they view that 6% drop as a discount.
They see a sale.
They step in and buy the dip. And RBC points out another crucial insight that completely defies common sense. The actual duration of the conflict historically has had almost no bearing on the speed of the market's recovery.
Wait, so it doesn't matter if it's a short skirmish or a long war?
Nope. Whether the shooting lasts for 2 weeks or 2 years, the market's initial financial healing process is largely identical.
It's like touching a hot stove then.
That's a great way to put it.
The market flinches immediately on the headline. That sudden, sharp 6% drop. But once the market pulls its hand back, looks around, and realizes the broader economic house isn't actually burning down, it just goes right back to work.
The flinch is just a biological reflex, yeah.
But the panic is not sustained. So if the length of a war doesn't dictate the market's pain, what does the actual timeline of one of these standard shocks look like?
Let's dive into some examples.
Yeah, how does that 28-day recovery actually play out in history?
Well, to understand the anatomy of a standard shock, we have to look at sudden events where uncertainty spiked from 0 to 100 instantly, and then watch the recalibration.
What's our baseline?
The Korean War is the perfect baseline. In June 1950, North Korea suddenly crossed the 38th parallel and invaded South Korea.
Okay, so a huge surprise.
Massive. It was a completely unexpected geopolitical shock right on the heels of World War II. And the S&P 500 reacted with severe, sharp fear. It fell 12.9% to its trough.
Which makes total sense contextually.
Yeah.
The world was terrified we were sliding straight into World War III.
Involving nuclear powers.
Right. Just 5 years after the trauma of World War II ended, a nearly 13% drop reflects genuine existential world-ending panic.
And yet, look at the underlying economic machinery of 1950. The post-war economic engine in the United States was running incredibly hot.
Manufacturing was booming.
Consumers had money, yes. The U.S. was not in a recession. And because a recession did not immediately follow the outbreak of the Korean War, the market found its footing incredibly fast.
How fast?
It recovered that entire 12.9% drop in just 56 trading days. And if you look at the shock event data, 12 months after that initial invasion, the market wasn't just recovered, it was actually up 11.7%.
Down 13%, then up almost 12% a year later. All while a massive, brutal, grinding conflict is actively raging on the Korean Peninsula with hundreds of thousands of troops.
The market just didn't care.
That is the definition of cold and rational. It proves the market aggressively separates the tragedy of the battlefield from the reality of the balance sheet.
It really does. And we see this pattern of swift drops and even swifter recoveries accelerate as we move into the 21st century.
Oh, interesting. So it gets faster. Because I can hear a listener thinking, wait, the S&P 500 in 1973 was dominated by massive oil-guzzling manufacturing companies. Today, the S&P 500 is dominated by Apple, Microsoft, Google, NVIDIA. It's software, it's cloud computing, it's AI. A tech company doesn't need millions of barrels of oil to run its business. Are they really that vulnerable to an oil shock?
It is a brilliant question, and it's the core of modern macroeconomics. It's true, Microsoft doesn't need a tanker of diesel to sell a software subscription.
Right.
But you have to look at the second and third order effects. Sustained $150 oil bleeds into absolutely everything. It drastically raises the cost of physical shipping for every single piece of hardware Apple produces.
Everything moves on a truck or a ship.
But more importantly, it crushes the consumer. If gas is $7 or $8 a gallon, the average American consumer is spending all their discretionary income just getting to work and heating their home.
They're tapped out.
They cancel their streaming subscriptions, they don't buy the new iPhone, they stop going to restaurants. The consumer taps out.
And when the consumer taps out, tech earnings collapse, just like manufacturing earnings did in the 70s.
Exactly. And then the final nail in the coffin. Sustained high oil prices cause massive sticky inflation across the entire supply chain.
And the Fed has to step in.
That forces the Federal Reserve to keep interest rates punishingly high to fight that inflation, which chokes off corporate borrowing and kills the valuation multiples of those exact tech stocks.
It's a perfect storm.
Path B drastically lifts the odds of both severe inflation and a deep recession simultaneously. If a 2026 war with Iran triggers that specific sequence of events, a sustained blockade of the Strait of Hormuz, it would look exactly like the Yom Kippur War aftermath.
A lost half-decade.
It would cause severe, lasting market damage that takes years, not weeks, to recover from.
It feels almost absurdly simplistic to do this incredible deep-dive historical analysis, covering a century of complex warfare, only to conclude, just watch the price of oil.
It sounds reductive.
But based on the cold, hard data, spanning from Pearl Harbor to Kyiv, that is exactly what the history of the S&P 500 is screaming at us to do. The kinetic war is the distraction. The energy supply is the actual target.
It truly is. And that is the ultimate practical takeaway for anyone listening to this deep dive.
Right.
If you want to manage your investments intelligently, rationally, through a geopolitical crisis, you have to force yourself to stop reacting to the battlefield headlines.
Ignore the noise.
The cable news networks will show you explosions. They will show you politicians yelling. Your job is to turn off the TV and look at the spreadsheets.
Watch the boring stuff.
Watch the boring, unglamorous economic metrics. Watch the global price of Brent crude oil. Watch forward inflation expectations. Monitor corporate credit spreads to see if banks are suddenly terrified to lend money to businesses.
All the stuff that actually drives the business cycle.
Track earnings revisions for the S&P 500 and keep a close eye on recession indicators from reliable, boring sources like the St. Louis Fed.
So true.
Those dry mathematical variables, not the mere existence of a war, are the only things that historically separate an ordinary 28-day bout of market volatility from genuinely lasting financial destruction.
We've seen that over the last 100 years, the market has learned to incredibly efficiently price in traditional kinetic warfare.
Very efficiently.
Whether it's tanks, troops, or even oil embargoes, the S&P 500 has developed an incredibly robust immune system for physical conflict. It bounces back in 28 days. But here is a final thought to leave you with, something to ponder as we look toward the wars of the future.
Oh, I like where this is going.
We know the market's resilience relies entirely on swift, rational trading, high-frequency algorithms, and corporate data flowing smoothly to investors so they can accurately price risk.
Right. Information is oxygen.
So how will the S&P 500 react to a future conflict where the primary target isn't a physical battlefield, but the very digital infrastructure, the undersea cables, and the data networks that the market fundamentally relies on to execute those 28-day recoveries? If the machinery of the market itself is blinded, how long does the panic last then?